Hi, Dr. Dolly. I'm in the process of purchasing an individual disability insurance policy. My insurance agent has told me that there is a maximum amount of coverage I can purchase, and that amount is based on my current salary. Is this accurate? Thanks.
So basically talking about the maximum amount you can purchase and how that's calculated, where that comes from. You want to talk about that?
Yeah, absolutely. So the way that it works, and there's a lot of confusion out there about that. When you're in training, you can get, typically if you're a resident, you can get up to $5,000 a month in coverage. Once you are in your final year, you're about to transition from training to practice, you can get $6,500 to $7,500 a month in coverage. These are all special programs for you while you're in training. Once you get out of training, the amount of coverage you can get is contingent upon two things. It's contingent upon your amount of income and how much other disability insurance you have, either other policies individually or group insurance from your employer. And so what happened was back in the wild, wild west of I think it was the 80s, and essentially a doctor could go in and be making $200,000, $300,000 a year, and they could apply for $500,000 a year in disability benefit. Well, what do you know? A lot of doctors and a lot of people were getting disabled, more than the norm. And so the insurance industry kind of came in and said, hey, look, how do we do this in a way that really helps people that need to be helped without creating this kind of almost like a marketplace for, hey, let's go get a bunch of coverage and then let's get disabled and try to make ourselves get disabled. So what they do is they look at how much coverage, they look at your income. And let's say you're making, and this goes way down the list, let's say you're making like $50,000 a year, they'll cover 60% of your income. And that's tax-free. So it should make up almost all of your post-tax income. Once you're making $300,000, $400,000, $500,000, they begin drawing that down. And so at $400,000 a year in income, they might only protect maybe 52% of your income. By the time you get to $1 million in income, they're only going to protect maybe about 25% of your income, maybe 30 at best. And the reason they do this is because if you have a doctor making $1 million a year and you keep them on that 60% basically repayment or benefit calculation, that same doctor who's working their tail off to make $1 million a year is going to say, I'm taking home about $600,000 after tax or somewhere around there. I can get disabled and bring home $600,000 after tax. Which one are you going to do? So they do decrease the amount you can get. And then whatever they determine your eligible amount is, 50%, 55%, whatever it is they're going to cover, then they look at how much group coverage you have from your employer or any other policies, and they subtract that. And then you're able to get that on that next policy. So, a lot of doctors come to us and say, hey, I'm making this big salary. How come my quote's only for this much? And we have to talk about, well, first of all, they're only covering 50% of your income. And then you've got this other policy from your employer. So that leaves you with, $10,000 a month in coverage or whatever it may be. So long-winded, but I hope it really gives you a good sense of there's very specific calculations that go into how they do it. But it absolutely, especially after training, it's going to be dependent on your income.
Let's talk about the options if you want more than that. I mean, a lot of times you can go to a second company and get a little bit more, or perhaps you can use some of the riders that I'm not a huge fan of, retirement riders, lump sum riders, student loan riders, catastrophic riders to maybe increase that coverage a little bit. Can you talk about those options for someone who actually wants more coverage than the company will sell?
Yeah, absolutely. And, to tell you the truth, when we talk to certain specialties or subspecialties, if we're talking to orthopedic surgeons, if we're talking to neurosurgeons, Mohs surgeons, interventional cardiologists, if we're talking to the higher income earning specialties or subspecialties, sometimes we'll recommend getting two policies. So let's say you're in training and you get $5,000 a month in coverage. It might be best to get $2,500 from one company and $2,500 from another. It doesn't really affect too much. You still have $5,000 a month in coverage. The price is going to be pretty comparable, but then you get the right to increase both of them up to a higher limit. This year, they have all gone up. They're all sitting at like $20,000 a month in coverage. Some of them will work together and get up to $35,000 a month in coverage. And again, that's tax-free. So at $35,000 a month in coverage, you pretty much have to be sitting at about that $1 million a year in income to get that with no other employer coverage. So they can work together. And you know what? Honestly, you could have 5 policies making up that $30,000 a month in coverage. It's not a number of policies thing. It's just a certain cap on what they have issuing limits and participation limits. Issuing is how much each company will issue on their own. Participation is how much they'll work together with other insurance companies to get you up to. So it's absolutely a viable way to do things. And then if you want to add some riders, if you max that out, You can get a retirement protection rider that will put money directly into a retirement trust for you that allows you to continue saving for retirement beyond the benefit that you're getting. There's also student loan riders where you can have money going directly to your student loan providers or servicers to help with student loans if you have them. We typically don't recommend those unless you're already maxing out the base benefit. Because honestly, we'd rather you just get as much base benefit as you can, protect as much as of your income, and don't have it where it's funneling to a trust or to a servicer. Have it come to you, and then you decide what your biggest need is at that time.
If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.